Okay, this is chapter 7, and in this chapter, we are going to be talking about the banking system and the role that money plays within that banking system. Okay, so one of the things that, when we look at the history of money and even the history of the banking system, the two are usually in close emergence with one another. In other words, once you have money, it becomes almost natural that you have a banking system. Generally, because economists face, just people in general, face this issue of having to smooth their consumption over their lifetime. And their lifetime consists of a period at the beginning and at the end of life where there is no income, and a period in the middle where there's more income earned than is needed to survive. So, to smooth that consumption over that time period, you need a banking system where there's both lending and savings, and then people engage in those um, activities based on where they are in their life. So to understand all of this, we just need to get some things out of the way in terms of the information problems that exist with a banking system. And the first of these is asymmetric information. So oftentimes you see asymmetric information in the insurance markets. This is more often where we see this. So the idea with the insurance market is that, let me give you an example. And I do not skydive. Let's say I know I skydive does not know, right? There clearly is an asymmetric information problem. Prudential Life Insurance, the company, gives me a life insurance policy and prices the premiums. Yeah, they're going to make a little bit of money, but the margins are actually thin as well in the insurance industry. And so because of that, right, it's a highly competitive market and the premiums are priced competitively that people pay, then the net result of that is I have a low premium that's given to me, but I engage in unsafe behaviors, right? Or let's say I eat very badly, or let's say I get drunk and act irresponsibly. All things that might prematurely end my life are things that Prudential doesn't know that I do. Um, Car insurance, another example, right? They don't know if I speed unless I actually get a ticket. They don't know I don't wear my seatbelt unless I actually get a ticket. And so a lot of the problems in the insurance industry are related to reducing this asymmetric information problem. And the reason why asymmetric information in general is a problem as well is because what it does is it leads to a waste of resources. And you get that waste of resources primarily because you either are going to, the insurance company could act defensively and say everyone skydives even though they all do not, and then basically overprice their policies, right? So I could be charged a skydive insurance premium price, and I might forego then getting insurance because the price is too high for me, the person who doesn't skydive. And so there's a part of me as a consumer of insurance who's generally in favor of insurance companies doing um, you know doing things like asking for a medical exam or things like that, because in general that kind of thing then stops someone from behaving irresponsibly, or at least the insurance company being able to charge that person more. Now, in the financial markets, we see this same problem of um, an information problem, but the information problem is different. Instead of asymmetric information, where the buyer and seller have different amounts of information, instead we have something called the adverse selection problem. In the adverse selection issue, it would be who's seeking out insurance. The person seeking out insurance is probably an individual who is engaged in risky kinds of activities. It's a person who, um, knows that they're possibly going to be making a claim. Um, and so you have to try to create a situation where um, either individuals are required to get the insurance, like we do in the car insurance here in Hawaii. But we also do that actually for health insurance in the US, but we also started doing that in Hawaii in 1974. We have in Hawaii one of the lowest uninsured rates in the country, even before the Affordable Care Act or Obamacare, whatever you want to call it. We already had one of the lower rates. So really the way to get around this is you can reduce some of the adverse selection problems by making it a mandatory purchase. Now, another information problem that we tend to see, and this happens in corporate governance, is the one of moral hazard. So moral hazard emerges when you have an incentive structure that doesn't encourage an individual to behave the right way. Let me give you an example that affects my line of work directly. I obviously am a professor. I already see people who have been accepted here and who are paying their bills. But not too long ago, I was asked if I wanted to be involved in new students to sign up to be at West Oahu. And there's a part of me that's like, dude, I don't really care whether they come or not. I'm not paid to get people here. I'm just paid to teach people once they are here. And the same could probably be said for people that work in admissions, right? They don't care about once you're here, right? All their behavior, all their actions are oriented around getting you here. Now, when we turn to a general organization, right, it's like, why should the cashier care if the customer is happy, right? Unless we find a way to incentivize the cashier to care about how the customer feels. One modern way that this is done for many employees is to give them stock options, meaning to give them shares of the business, right? Or to maybe give them a kind of managerial role, like, shift leader or shift manager, or give them some sort of thing to move up to. And basically what that means is aligning the incentives. So this would be like my wife works in the finance industry. Almost all of her compensation is oriented around the moral hazard problem. And that is that most of her 98% of her compensation, not 98%, but some incredibly high 90s kind of percentile, is all bonus and commission, meaning it's completely oriented around how much she is, how much work she is doing and how much revenue she is generating for the firm. So she works for a big financial services company, and so that company obviously cares about its employees and their ability to generate revenue. Now, there are people at her firm that are like in regulations and in compliance and all these other sorts of things. Their job is obviously nothing about bonus and commission, but those are very few individuals. And then finally, you get this principal agent problem, at least in corporate governance. And in corporate governance, it means how do I basically get people to act the way that I wanted them to act? Again, this would be kind of the aforementioned stock options, maybe giving people a raise, giving people a promotion. There'd be lots of ways that you can get an employee to keep doing good work. And I've now already talked about these, at least the first one, how the moral hazard problem exists in insurance. Again, that's in insurance, that's people behaving recklessly because they know they have insurance that's going to cover the risk, right? So that would be, I've got health insurance, so I will eat a big fat burger, right? I've got car insurance, so I will drive faster, right? And so on and so forth. Those aren't, it's not new to the insurance industry. And so they create structures to make someone like myself, even if I have insurance, that it's reflected, right? So even though I have insurance, I still bear part of the costs, meaning I have to make a co-payment, I have to pay a deductible every year, and all of those things are part of ensuring that I don't behave 100% reckless, that I face a little bit of an incentive to behave the right way. And you see that also in car insurance, right? I have to pay a deductible, but also that I have to, if I drive recklessly too much, that they'll drop my coverage. We see this in lending. In moral hazard, we see that if you, for instance, you generally have to secure some property. You have to give the lending agency something in case you don't pay back the debt. And what that does is it ensures that I don't just walk off without paying my debts. Also, we have things like credit scores and bankruptcy that ensure that I, again, don't behave without the bank's interest at heart. And we also see this in the debt and equity markets. We see that we have credit ratings as well in the debt markets and in the equity markets. We know that the share price certainly ensures, along with the credit score and the threat of a takeover, ensure that I don't take on too much risk. And when we look at, in the financial market specifically, that moral hazard problem, again, we would have restrictive covenants. So the covenants would see certain conditions that must be met. Right, so I could say something like, this loan is predicated on you meeting a certain amount of sales per quarter or per year. And if you don't, I demand all payments back right away. You can do that. You generally have a board of directors where the lender has some either direct representative on the board of directors or someone that is sympathetic to their cause. As I kind of pointed out in the insurance industry, you certainly see that the premiums adjust. The premiums and the deductible adjust based on the level of moral hazard that likely exists. And then you also see that for compensating balances, what you do here is that you ensure that an individual has to keep a certain like a minimum balance at the bank to ensure that they can continue to make their payments. So in other words, you know, well, my bank does not do it for my my little mortgage. Well, it's not little, but you know what I mean. In the scheme of a corporate world, my mortgage is little. But if I have an incredibly large loan, I probably have to have my payroll account, checking account with them, so that they can make sure that I'm not, you know, misdirecting insurance premiums and using it to pay my bills or things like that. So a compensating balance, again, it's just kind of like a minimum balance at a bank to ensure that I can meet my payments. Okay. Now, let's turn to what, with that all said, in some sense, the role of the financial market is to overcome why you need a financial market, and then we'll get to a bank, and then we'll get to money. But the reason why you need a financial market is to overcome those issues of moral hazard, asymmetric information, adverse selection. You need a financial market to price those risks. And in some sense, I think it's generous to say it, but I think certainly if you're talking to someone in the finance industry, my wife included, that they would say that that's what they get paid for. It's a bit generous to say that that's what they do, but as an economist, I tell myself that that's what they do. Right, a critic of them, right, someone who's trying to think of what we would call that person. You know, someone who's very progressive and socially conscious generally dislikes financial institutions and banks and sees them as leeches on society with fees and how they direct the agenda of society towards, you know, more and more money. I think that's one extreme. I think the other extreme is that they remove asymmetric information problems. I think the truth is probably somewhere in the middle, more likely than not. You are free to think whatever you want, except for the purposes of this course. If I ask you a question, a theoretical question about what financial markets do, you should say remove information problems. Now let's transition from the financial markets to one of the entities that exist in that financial market, which are banks. What do banks do? More important than anything is that banks provide liquidity. When I just started this lecture, I said, right, banks exist to smooth out spending and income over a person's lifetime. You know, when I, what was it, like 2 weeks ago? I think I had $17 in my checking account. Now, again, you know, someone might get concerned about that and be like, wow, Scheiding, you are facing a financial crisis here. It's really not. It's actually a liquidity crisis. It's not a financial crisis. A liquidity crisis means that there's not a lot of money in my checking account, but right, I have certain assets I could deploy to, you know, that I could turn into cash, right? Like, you know, just like most households, right? I have a car, I could, you know, sell that car. You know, I have junky clothes, I could sell those junky clothes for Halloween costumes, right? I mean, I have things that I could sell and generate the cash. Instead of having to do those things, like sell assets, though, I can also go to a bank. And at that bank, I can ask for a loan that I would be granted based on my credit score and the bank's perceived ability of my, ability to repay. And so banks provide that service. They give me the liquidity without having to sell things, right? I mean, if you think about it, I'm able to buy a house even though I don't have the money for a house. And I do that based on the fact that the bank deemed me likely to be able to, over that 30-year time period, be able to have the cash to do those things. And so that's what the rest of the slide basically points out, is that you have some things that are incredibly liquid, like a checking account. A checking account is immediately available cash. My car, my house are illiquid. You can sell them, but it takes time and it takes money to sell them. What the banks do is they overcome that mismatch between these two extremes. Now, the other thing that banks do is that they reduce the transaction costs. By transaction costs, you mean is that there are savers and there are lenders. These two groups exist. If banks weren't there, then you can still borrow money, except you don't have to borrow it from a person, right? And a person's going to charge you more. They're going to charge you more because they're not experts at lending money. They're going to charge you more because they do a small volume of business. They're going to charge you more because they know you don't have a lot of other options. For savers, they might be willing to accept less. And they might be willing to accept less because there's, generally speaking, a lack of security in the markets. So in financial markets, you have savers that are looking for borrowers, basically, right? Savers, lenders, let's change this, not savers, not lenders, but borrowers. So you've got savers and borrowers, and they are looking for each other. They need each other. And so because they need each other, the banks serve as matchmaker between those two groups. And that's what they get compensated for, is being Match.com. Now, one thing that the banks also do is they basically then lump together either the deposits of individuals or the loans of individuals, and they bundle them into something that can then be sold to investors or sold to others. Right, if I wanted to, let's just take a Ally Bank. It's an online bank. They make a lot of car loans. They make a lot of car loans because they used to be, before they are now today called Ally. Before they were Ally, they were the lending business for General Motors, Chevrolet, Buick, whatnot. And then after the 2008 financial crisis and the bankruptcy of General Motors, that company, which is called GMAC, General Motors Acceptance Corporation, they couldn't keep that name anymore. You wouldn't want to keep that name anymore. So they called themselves Ally. But they still have a lot of car loans. Now, those car loans run a wide spectrum of individuals. It's not just General Motors cars, right? It's individuals that have, lots of money and they have a Mercedes Benz and they're just making the monthly payments and they have high income. And then you've got individuals who have a 15-year-old Honda Civic that they bought at a used car dealer, and they've got, they're paid in cash, their server, and they're able to make the payments when times are good and they're not when times are bad. Well, you don't want to just bundle loans of bad credit risk. You also don't want to bundle it actually with only good credit risks either. You don't want one just bad because then it's more likely that one's going to fail. And you don't want to build a bundle with just good ones because then the amount you would get paid for selling that loan would be very little because there's almost no chance of default. So what the bank needs to do is it's going to get compensated for bundling and how good it is at bundling the loans. You want to put in just enough safe stuff that it can compensate for the fact that some of the bad loans are going to fail. The bad ones that are going to fail give you more money as like interest rates, but there's greater risk involved. But the good loans are going to compensate for that risk, and the bad loans are going to compensate for the lack of payments on the good side. They do this with mortgages, obviously. We saw that in the Big Short movie. But they do these things, and it basically diversifies the risk within each bundle. And right, if they do their job well, they would need to be compensated for it. So now there's a part of me that doesn't like doing 75A, 75B. And that's because, quite honestly, the banking system has changed even in the past few years. By that I mean, let me kind of show you an example here of how it's changed. Not looking up GDP, I'm just getting the thread. Really, they discontinued it? Why would they discontinue it? Unless you... Why would you discontinue it? Well, I know why they discontinued it. That's a different issue. That makes me really grumpy. This is going to be the thing I'm grumpy about today. You probably think, wow, Scheiding, you're really fucking weird. But this graph should basically tell you how scary the economy is today. So it would only make sense that they wouldn't want to at least release the data. I mean, I'm sure they're collecting the data, they're just not releasing it anymore. And I think it's pretty crappy that they would decide to do that. I guess I wasn't aware of it until just now. They did stop collecting it last September. This bothers me. I feel like I just want to get a drink. This is really bad. Okay. Accommodate, Scheiding, accommodate here. Okay. The reason why this graph is scary is because let's take just a step back here, just so that you can clearly see why I'm grumpy right now. So banks take in deposits, right? So let's say a bank takes in a deposit of $100. The bank is subject to two things. Well, really, technically only one thing here. Is that it has a required reserve rate. For most large-sized banks of any significant size, it's 5% or less. Let's just say it's 5%. That would mean of this $100, they have to keep $5 in required reserves. And then they have $95 in excess reserves that can be lent. Now, when you took 131, especially if you took it with me, we would focus then on the fact that then banks would make a loan for $95. And then that $95 loan check would be deposited. They would have to keep 5% of the $95, right? And so that would mean that sorry, I'm just math lazy here. That they would have 90-25 in excess reserves and 475 in required reserves. $475 being 5% of 95. And the 90-25 basically being 95% of 95. And then the process would continue. Now they would lend out $90.25 and so on and so forth. And this process would continue until it was zero. And then we would have this equation that $100 in initial money, and we would multiply it by something called a simple deposit multiplier, which was 1 over the required reserve ratio, which in this case would be 100 times 1 over 0.05, which is 20. And that basically the banking system, doing what it does, can turn $100 into $2,000. And that is the power of the banking system. Now, before you start chanting, USA, USA, look at this. That for pretty much as long as one can see here, banks did exactly what we said they did, which was they lent out all excess reserves. And then the financial crisis happened. And it fundamentally adjusted how banks behave. And that now they are both cautious, so they have excess reserves, but also they're running out of places to lend to. And then, as if that's not bad enough, then look at the financial crisis, or look at the economic crisis caused by COVID, right? It nearly triples the amount of excess reserves. And we don't even know what it is today. That's the part that bothers me. We don't even know what it is today. So, I talked about now those slides. It just makes me really grumpy. It makes me grumpy though, because what it does is it basically means that it's somewhat a sign that you've overstimulated the economy. And it creates undue risk in the economy because now you've got banks sitting on a bunch of cash. And most of these banks also are have to report to shareholders, right? Like First Hawaiian, Banco, Central Pacific. They have shareholders that are demanding, right? When you hold an excess reserve, you get a slight interest rate from the Federal Reserve for holding extra money, but certainly not as good as lending it out. And so if you look at the earnings call for like Central Pacific Bank and Banco and First Hawaiian, right now, the way that they're able to make money is by lending out lots of money for mortgages. Which, right, means maybe hopefully it's not me when I say this, but right, you end up lending to poorer credit risk because that's the way you're going to be able to make money. Okay. Now, one of the problems that we also see here is that banks at least face somewhat of a risk of having what's called a bank run. And a bank run is created by the fact that we have a fractional reserve banking system, meaning the banks don't hold all of their cash. So when I used to be at the Federal Reserve, we would focus on bad banks from time to time. And the way that that process would work would be is that if we knew the bank was going to fail, we didn't want there to be a run. We didn't want all the depositors going to the bank at once and demanding their cash back, because that certainly dooms the bank. So there's this precious little time period where you, as being with the Federal Reserve, you know that the bank is going to fail, but you don't want it to fail. So you try to engineer a sale to another bank without telling anyone about it. And so if you can do that, you encourage the sale, and then the bank will say, hey, we just sold ourselves. No need to worry about how bad we were because now we just got bought by someone else. So keep your deposits here. That's how it happens 95% of the time, is another bank will buy that bank because there are some structural problems. Most of those structural problems can be overcome by the fact that the bank can gain more branches and more customers quite cheaply. But you do get small, like community banks and whatnot, that are independent and can fail. And then what we would do at the Federal Reserve is on Fridays, this is when banks are just open Monday through Friday. On a Friday at about like 4:45 p.m., like 15 minutes before the bank is going to close, we would show up. We'd put a sign on the door saying this bank is closed. You can't get your deposits out for a little bit. And then, the depositors didn't have to worry as much about their cash because there's deposit insurance. So here in the United States, we have what's called the FDIC, Federal Deposit Insurance Corporation. If you belong to a credit union, you have the NCUA, which stands for the National Credit Union Administration. Let's just see. God. I know, get over it, Scheiding. Let's see who failed this last week. If anyone. Probably no one. But maybe. Sorry, give me a second here. I'm probably hiding that too. So again, this is kind of the FDIC website. You can actually learn a lot more about insurance that exists, but it does pay. It pays out $250,000 per depositor, per bank, each account ownership category. So, I mean, you can have a joint account and a single account and get $500,000 from the same bank. But those limits are adhered to. So I would remember an example of, we closed this bank somewhere in Wisconsin, and it's like a small community bank. And it had the payroll for the local school district, right? And I think that account had something like, don't quote me on this, but I think it had something like $11 million in it. This is back in like the early 2000s. FDIC pays out $100,000. Sorry, that's obviously a huge, huge, huge loss for a local school district. And all that the school district then is, it's just in line with all the others in the bankruptcy court for that bank. Okay, well, they used to make it a little bit more obvious who failed this week. I'm suspecting that they don't want us to know who's failing. Okay, well, you're not watching you don't want to watch a video with me looking for things on a website. So let me just try one more thing. Go back to data tools. That's all right. I'm okay. And then you get these, the problems emerge when banks are unwilling to lend, such as the 2008-2009 financial crisis. The reason why it's called a financial crisis rather than a housing crisis is that really it was the destruction of the financial system that made the 2008-2009 crisis so severe. And that was that banks were unwilling to lend money because no one trusted anyone. And even though we are some 12, 13, 14 years out from that crisis, as you saw in that one chart of excess reserves, banks aren't still lending at the level that they used to. And so there's been a dramatic loss of trust in the system. Now, without credit, without a banking system, the economy collapses within a day, within 2 days, the economy collapses, which is where we were at in September of 2008, was an economy on the verge of collapse because the banking system was under that much stress. And that's what this slide basically says is the economy collapses without the banking system. That's how important they are. Now, that simple deposit multiplier that we identified, that's that 1 over the required reserve ratio. Again, it assumes 0 excess reserves. We know that that's not true. It means that the public doesn't hold cash. Also, not true. And especially during COVID. People hoarding cash actually was up because people either didn't want to go to banks or something else. Okay, so what this chapter then basically highlights for us is the important role that banks play in the system, but also the way in which the market has changed dramatically, even since this book was written, which wasn't that long ago.